We talked about tax loss harvesting, but the problem with that is that it's based on it going down. And if you're selling your business, say, next year, I can't say with any certainty that there'll be downside exposure. You may be in an extended bull market, or there could be, I just don't know. So the way that you can actually level up and take a more strategic, sophisticated approach to this is more advanced tax mitigation strategies. We take a more sophisticated approach when it comes to tax loss harvesting with more certainty. So the number one key is that you have a core portfolio that is designed and managed to grow your wealth. Number one, that's the priority. The number one priority should be always to grow your wealth and manage for risk. The number two priority is how do you engineer tax losses? So this is like having your cake and eating it too. How do I grow my wealth and create tax losses at the same time, right? So this is how you do it. So we talked about that tax loss harvesting strategy earlier with BP. So you have a core portfolio, and that core portfolio, let's say you have $10 million in that core portfolio. That's your equity. Then, utilizing advanced strategies through advanced professional money managers, we utilize excess leverage. And the leverage will allow us to purchase more stocks above the 10 million, which we call excess long. And at the same time, we short stocks, which is excess shorts. So you have your 10 million core portfolio, and it's sandwiched with more stocks on the buy side and more stocks on the sell side. Now, just stay with me here. I'm going to kind of get into what shorting is if you don't know what shorting is. Shorting a stock is you borrow a stock, and don't worry about who you're borrowing it from. Professional managers take care of that. And you've borrowed the stock to sell it in the market, and then you have to buy it back at some point in the future. And if it goes down, right, you get to buy it back at a lower price, and you get to keep the delta. So if a stock goes down, you actually make money on a short. It can be very risky by itself. But in this scenario, you have your core portfolio that's built to grow. Right? There'll be some ebbs and flows to the market as always, but that's your core primary purpose. And then you're sandwiched with excess longs and excess shorts. But here's the magic. The longs and shorts are designed to offset each other. So perhaps you are excess long Microsoft and excess short Oracle. Very similar market, or long Coke, short Pepsi. So if soft drinks and software go up, right, the excess longs will make money, and the shorts will actually be squeezed. So you would lose money on the shorts, but the core portfolio really wouldn't have any downside action, because what you would lose in this scenario on the shorts, which we would go in and realize those losses that live on your 1099 and go on your tax return, those losses in the portfolio are now offset by the gains of the excess long. Are you with me on that? And so if you have a diversified portfolio of hundreds and hundreds of companies with hundreds and hundreds of long excess and short excess, we are able, through our professional money management partners, we're able to tell almost to the day what the estimated tax loss we can expect depending upon when we deploy capital, right? Meaning if we deploy in January, we have a full year versus, say, June, right? Which we'd only have, say, a half of year. And also how much leverage we wind up taking, meaning how much excess long and shorts we're taking on the up and the downside. So in many cases, when people come to us and say, hey, we signed an LOI and we're closing in 2 months and it's February and we've got a limited window, we kind of know what we need to do. And then we can say with a high degree of confidence of what the estimated tax losses we can engineer between that date and the end of the year, which can, in many cases, offset a lion's share of the tax exposure on the exit of the business. You with me on that?